Hello, future millionaires, and welcome back to the Get Rich Slow podcast. I'm your co-host, Adrian Schermer, joined by Robert Delavan. Rob, how you doing this morning?
Wonderful. Good morning.
And today we're going to talk about something near and dear to my heart. We were just talking about that. I can't believe it's taken this long, but let's talk about home lending. Let's talk about it from a core novice perspective. And then I want to work our way into the more complicated stuff. We've talked a lot on this about, everything, vacation rentals, how to leverage equity in your house. But let's get down to the basics. What do you say?
Yeah. So this is a fun one for me because we run into this all the time. And what happens is people generally come to a realtor first, right?
Yep, absolutely.
And then I'm referring, or my team is referring Adrian as the lender. And the reason we're doing that is, okay, we could go out and show you, 20 homes based on, HomeSnap, Realtor.com, or there's a whole bunch of others. And because you've been shopping, window shopping, whatever. Ooh, I like this house. It's 400,000. I like this house. It's 550.
Yeah.
Which is a big range, right? Based on income and qualifications. And we're like, okay, well, we're not going to look at $400,000 homes if your taste is 550, and that's what you need for your family. But we're also not going to look at 550 if you're only qualified for 400. So enter stage left, Mr. Schermer.
Absolutely.
And that's where we're like, okay, you got to talk to a lender that, number one, we trust. We've talked about that in other episodes, but let's just assume that all parties are, the best, top notch in their fields. And it's like, okay, Adrian, do your thing. Well, what we want is a pre-approval letter. What we actually are talking about, the pre-approval letter is just a product saying you can afford up to X. What really goes into that pre-approval letter is what we wanted to talk about today, and kind of more like unpacking the why. And it comes back to, what kind of income do you make? What can you afford? And there's all of these little boxes there's a box that we have to basically put the client into.
Yeah.
So start us there. I've referred you, Adrian. You're going to do your, typical new client introduction, presentation, that sort of thing. So start us down that process.
Absolutely. And I'm just going to skip the song and dance of this because there's a lot of maybeism out there when you look up this data. You need a pre-approval. You cannot make a real offer on a house without a pre-approval.
Right.
Of course, there's going to be exceptions to what I'm saying, but realistically, for most people, if you don't go to the bank and you don't get your pre-approval, there is an aspect of wasting your time. Now, if you want to go shop and you want to figure out how much does the house that I want sell for, and is that even, just to have an idea. But sometimes people come to me with budgets where they're like, I want to spend 300 or 400,000. No, you probably don't. It probably genuinely matters very, very little what the house is worth. What matters to most people more than anything is the monthly payment and how it fits in with their lifestyle. You've got to make the decision generally from that backwards, because cash flow is important. And we talk about it, everything from budgeting to retirement savings, et cetera. You've got to decide what chunk of your money is going to go into this. And it's different than rent. Same thing. A lot of people go, well, I'm paying $1,500 for rent now, so I want to pay $1,500 on the other end. That is a good strategy. Obviously, you're going to be able to live at the same comfort level, but you're also taking a step forward in life. And a lot of people will end up spending more once they start having the conversation, because the gain in equity and the fact that it's going to go up a little bit, taxes and insurance are part of your payment. They're going to go up, right? But those are just a portion of the payment. And that amount of raise per year is traditionally a lot less than how much rent goes up. So even if you start paying more than you would have paid to rent the place, which is more common in metro areas, less common in rural areas, that curve of rent is going to climb up over. And then one day you can be that person who says, yeah, we got our house 20 years ago for what people now make a year on average. And our payment is, 1/3 of what rent is right now. So
to throw some numbers in there.
Yeah.
Typical rent, for a little 2-bedroom place in the Portland metro area, maybe not in the nicest, trendiest, walkable neighborhood, but just, a typical
average
suburb. $1,500-$1,600 a month is pretty typical for a nice 2-bedroom, right?
Yep.
That's run of the mill. That's just typical. So, oh man, I'm going to buy a $400,000 house, and the payment's going to be, including taxes and insurance, fixed payments. And let's just assume for this conversation we're doing fixed payments. Oh man, the payment's going to be $2,200 a month, right?
Mm-hmm.
So be it. 5 years later, that $1,500 place may be renting for $2,200, and for $400,000, you bought a 3-bedroom, 2-bath house.
Yeah.
So
and
you're
by the way,
getting
it is,
more.
because I know what the rent was when I got here 10 years ago. So
Exactly. But what happens is 10 years later, that payment of $2,200, now the rent's $2,500. 20 years later, the rent for that same place is $3,500. And people are like, what? You live in this house for, $2,200 a month? Like, oh my gosh, this is crazy. And there's that crossover. So that's just
and another factor here too, that I don't want to spend too much time unpacking, but I will give an aside, is that people also have to factor, if you don't have any money down, or you've got very little money down, you're doing the 3% down, you're doing a program that's going to give down payment assistance, you're doing USDA 0% down, VA 0% down, you're doing FHA 3.5% down. All these programs have very low down payments, but there's usually a catch-22 to it, and it is that you're going to pay something like mortgage insurance, which is going to bump your payment up, and it's going to be a portion of your total payment. But that's okay, because again, that's the short-term problem, and then you build that equity, and then you can drop mortgage insurance. On average, in at least our metro area, people buying with even 3 to 5% down would have that 20% equity position where they can drop the mortgage insurance out of that payment within 4.5, maybe 5 years. That's
Very
not
typical.
crazy. That's not, using exceptional numbers or a great year. That's just normal appreciation and paying down the balance at the same time. So
very typical.
We've crossed that bridge. What do you want to do when you want to go out shopping for a home? Again, interviewing realtors, figuring out who you want to work with, who's going to be your realtor and your lender team is great, but the lender has to give you that pre-approval letter for you to get out there shopping. And the process is, it's not as difficult as I feel like it may be made out to be. It really is pretty much as easy as a lot of other lines of credit. Applying for a credit card takes filling out a form online. It's pretty much the same thing with a home loan. We just go a little bit of an extra step. Let's use someone who's the W-2 wage earner as an example. So you get paid a salary or an hourly wage, you get paychecks, you get W-2s at the end of the year. Typically, we're going to need 1 or 2, more often 2 years worth of W-2s, pay stubs covering the last 30 days worth of income. So like if you're paid biweekly, that's a couple paychecks. If you're paid weekly, that's 4. And then a copy of your photo ID and a couple of your most recent bank statements for any account that's going to be used as a source of funds for the transaction. And then, that, and the same thing as a credit card application, is all we need.
Right. And tax returns, right? You mentioned.
Don't need tax returns if you're a W-2 wage earner. Actually,
gotcha.
W-2s.
Okay, that's right.
We end up ordering
I'm coming at this
to verify.
From
you're going one layer deep, which is self-employed. But again, not the craziest thing. If you're self-employed, you've got this data, right? You've got to have this data. You've done your stuff. You've gone to a CPA. You've either got personal tax returns in which your business is already in there because you're sole proprietor or something along those lines, or you've got yours and your business returns, which you cycle through like with an S corp or an LLC, whatever it is. You're paying yourself out of it, or you're just accepting the profit of the business. Either way, all we need is the federal. We don't care about the state, unless you owe money to the state. If you owe money to the government, that's like the same as owing money anywhere. And then we just take all that data and we figure out what you can qualify for. And it's kind of interesting because I think this is because of the consumer level. It's easier to digest if I tell you, hey, the budget's $300K, go out there and put that as your filter top cap. But the reality is that what we as lenders are qualifying you for is a maximum payment. So, and the reason I say that is because I've had plenty of examples, same purchase price of a house, a block from each other, but one is taxed at a higher rate than the other. And that comes down to county assessments. Maybe one was built 20 years earlier and, it's considered an older building. The assessor assessed it lower. There's all kinds of crazy stuff. Maybe one has a higher homeowner's insurance. If a house has a pool, you can probably expect the homeowner's insurance to be about double what it would have been if it didn't, because now, now there's a risk on the property. You've got this body of water that someone can get hurt in. So insurance is naturally going to be more expensive. My house, my insurance is insanely cheap because I can see an emergency room right out that window. I happen to be close to emergency services. I'm on a main strip. It's a brand new house. There's very unlikely that I'm going to have an electrical fire because this is brand new wiring at current code. If you buy a house that's from 1920 that has what's that? You know all the terms.
Knob and tube.
Knob and tube. Go look up knob and tube to get an idea of just how crazy dangerous we used to do things.
Right.
Then it's going to be different. So, we do this a lot in our podcasts here, right? Where we're like, your results may vary. And this is true, but bear this in mind that if you find something that's a little bit higher than your budget, but it's got really cheap taxes, maybe you could squeeze to get that.
Right.
It all boils down to debt to income ratio in that. You may have heard the term 3 C's of credit. So we're looking at credit is one of the C's. Collateral, which is the building itself. We're going to appraise the property. That's after you get under contract. So that's not really a worry for you right now. And capacity to pay. And capacity to pay is about your debts as a portion of your income. How much money you owe does not matter, except in the fact that it relatively has a payment. But that said, I had a gal who, I think I used her as an example before, $30 a month was the payment because she's in deferment, income-based deferment on $60,000 worth of student loan debt.
Right.
You have a Best Buy card that has a $100 balance and they want a $35 payment on it. That's hitting you harder in terms of qualifying for a loan than that $60,000 school loan. So it's about the minimum payments on the loan. Doesn't matter if you normally overpay or you pay it all off every month. We're looking at the minimum payment. The credit's very much a snapshot of where things are. And any good lender should be able to work with you a little bit there. If you got a card that's screwing up your debt to income ratio, but you can afford to pay it off, they might have you do that in the process to clear up a little more room in the debt to income ratio.
Right.
But that's the big thing we're doing. We're looking at what is your qualifying income. And for self-employed folks, by the way, that's your net income as you report it to the federal government. Right. Not what you pull in necessarily. There are a few lending products that generally have a higher interest rate, but can look at cash flow instead of taxes. That's a whole different episode or set of episodes. But for most people, 99+% of the lending that happens on homes for individuals, we are fitting in government guidelines. And since the government, effectively insures these loans in the back end, that's what we have to do. We have to look at what you told the federal government that you made.
So let me break it down a little bit more, or just, pretend again that I'm the moron, right? So just for math's sake, let's say the person that makes $10,000 a month, right, versus the person that makes $5,000 a month. And the debt to income ratios, at $10,000 a month is roughly in that low 50% number, right? Like 55, 57 sometimes. So let's just, for simplicity's sake, let's just say 50%.
Don't do this math yourself, by the way.
Exactly.
There's so much more to it. And there's exceptions to rules that are made.
Absolutely.
So don't listen to this and go, oh, Adrian told me I can just run the math myself and I can't afford a house. So, don't do that. The rules change all the time. They'll probably be different by the time this episode hits. There's continuous micro changes that slowly change the scope of all of this stuff. So you got to talk to someone who does lending. Doesn't have to be me. It can be any of a number of awesome licensed people.
Right. So conceptually, $10,000 a month, they can, and let's say they have $2,000 a month in, let's say they have a couple auto loans, a credit card, and a student loan, right? And the monthly payment on all those together is $2,000, and they're renting somewhere. So in theory, they can afford $3,000 a month to borrow, which roughly for every $100,000 you borrow on a 30-year mortgage, right? You can, is about at like 3.25%, is like $450, $475 a month, give or take, right? So if I take, let's say $500 a month, because I always like to round up, then they could roughly borrow, let's say $500,000, and then that leaves $500 a month for taxes and insurance, which would push them up to, now they can afford a $3,000 a month payment, which is probably about a $550,000 to $600,000 house, give or take. And I threw a bunch of numbers there, but the bottom line is that $10,000 a month income earner with $2,000 in already set monthly payments on auto, and what did I say? Auto, student loans, and say a credit card payment.
Yep.
Right?
Pretty
They're going to
typical.
be able to buy roughly and be pre-approved for roughly somewhere like a $500,000 to $600,000 home, depending on how much they put down, versus that $5,000 a month earner. Right? We just went from $120,000 a year to $60,000 a year. That $5,000 a month earner is not necessarily going to be able to be like, oh, they can only afford a $300,000 house versus a $600,000 house. Let's say their payments are, let's say they don't have any debt. So they could afford $2,500 a month. They're completely debt free. They could probably afford a $450,000 house, only $50K less, maybe $100K less, something like that, in a similar scenario. But if they're loaded up on debt and they have $2,000 in debt a month, just like the guy that's making $10,000 a month, now they basically got to pay down all that debt or restructure it or do something,
Absolutely,
so that they can afford anything at all.
Absolutely.
So that's this concept of, you got to go through that application process with an Adrian, as a mortgage lender, to figure out where you're at, because we talk to people all the time, and if we can have a lead time of a year or 2 years or 3 years, and they're that guy that's making $5,000 a month, well, they are, not in a point at all that they could buy today, but they know that they could sock away and pay off that car, pay off that student loan debt, pay off that credit card, whatever.
Yeah.
And, say it's $30,000, $40,000 in debt, could totally free up, over 2 or 3 years, maybe quicker. They could free up and they could buy that $400,000 or $500,000 house if they get out of debt. So you have to know this, and each individual situation is different. But it kind of comes back to, the math doesn't change, but the individual overall situation has an unlimited number of permutations.
Yeah, absolutely. Absolutely.
So,
and everybody has a different, there are so many little tendrils I could dig into, all the different types of situations. Down payment's one of the big ones. Honestly, down payment's probably one of maybe the biggest thing that prevents people from even applying for homes. And I've talked to so many people who go, oh yeah, you're right, I do have $10,000 in a 401k right now. I hadn't even really thought about that, but I've been slowly piling that in the background because I work at a desk job. Well, they said I can borrow up to 60% of that if it's for a home loan. Well, now you borrowed $6,000 for yourself towards a down payment. That's,
3% down. Now you bought a $200,000 home.
Mm-hmm, mm-hmm.
So,
and there's this discouragement right now, right? Like, hey, I can't afford, a 4-bedroom house costs this much and minimum wage is that much. I see this online all the time. Don't dive right into the forever home. That's not how most people do it. That's not how your grandparents did it. That's not how your parents did it. Most people don't do that. Most people don't just buy, and the very first home they have is the one they just stay in for the rest of their entire life.
But Adrian, I saw it on House Hunters or HGTV, and they made it.
the basket.
I'm sorry. There's just that element of the bullshit of Hollywood, if you will, right? That's hey, I want it and I want it now. Well, guess what? You're paying rent, making somebody else rich versus doing it yourself.
Absolutely. And there's condos out there. People think it's a sucker's game. Sometimes I've heard people be real negative about cheaper homes like this. I got to pay a condo association due, and on and on and on. But yeah, you do, but it's still better than renting, and you still build equity. And then I've watched those people sell those condos and now have that $50,000, $100,000 down that makes it so that they have the larger buying power. Now they're putting 20% down on the property that they really want to spend the next 10, 15, 20 years, and they want to raise their family in that home. So we talk about getting started early, and that's kind of one of the problems that I run into people with is they've already at that point. They already had their first kid. It's a toddler age maybe, but now they're like, I don't want to move into a condo with this. And that's how you can get stuck renting, because then you're renting a whole house for your family now. And now you're paying, what is it now? It's, it's $2,000 a month plus to rent a family home in at least our metro area.
Right.
And while it's cheaper out in rural areas, there's an income disparity too. So
Right.
that's how
And
you can
commutes
get
and
funneled into that little pigeonhole where it's really hard and it feels difficult to chew out. But like I said, down payment's a solvable problem. And this is a very consultative process.
Mhm.
What I always want to try to get back to with this is that, I don't charge people anything to come into my office. And I don't consider it a waste of time when I talk to someone who's not ready. No one is not ready in my book. They're just not ready
Right.
yet. Everyone
Right.
is an opportunity to grow you up to that point. And I have some clients it took 2-3 years. Honestly, they're some of the most rewarding transactions to me
Oh man.
because we talk about credit and we talk about changes that can be made and we do check-ins every 3-6 months. And then a few years go by and we go, holy cow, we're really here. We really did it. And
Right.
for some of these people, it meant getting better jobs. It
Yeah.
meant, but if you don't have the metric out there, you don't know I need to make more than $20 an hour and then I can afford that house that I want. You're selling yourself short. You got
Right.
to have, what's the Michael Jordan quote? You miss 100% of the shots you don't take.
You don't
If you
take
don't get out there and
exactly.
even ask the info, there's a lot of people out on the internet right now who they just seem hell-bent on convincing people that no one can afford a home.
Right.
And they're liars, man. They're lying. They're lying to the
Well,
people. And it's
right.
just such an acceptable lie because it's
Right.
easier to absorb that and just go, yeah, I might as well not even try.
Right. And
Breaks
it's
my heart.
what we're talking about here is we're removing the natural human instinct to fear the unknown.
Mhm.
Is as soon as it becomes no longer an unknown, then it's something that you can plan and goal set for, right? And versus just, oh, yeah, oh, real estate's been crazy, hasn't it? Oh man, my rent keeps going up. Oh, life just sucks, right? I'm never going to be there.
Yeah.
That's what rich people do. Well, yeah, that's our audience. It's literally right there, as for my listening audience, I'm pointing to the everyday real estate millionaires every day. That's what we're trying to do. And it starts with 1-2 months or 1-2-3-4 years talking to Adrian. Somebody who can say, hey, this is where you're at, this is where you're going to need to be. And in conjunction with a real estate broker is, hell yeah, we'll take you out. We'll have you look at some property. We're not going to look at 20 different properties before you're pre-approved, but if you're close, I'm going to send you to have that conversation with Adrian immediately. And then
Yeah.
we're going to say, hey, based on where he has established that you're at, let's sit down and goal set and figure out, the best steps. We're not trying to waste anybody's time.
Mhm.
We're not going to go home shopping hardcore when we're really tire kickers and we're not legitimate buyers yet.
Right.
But it's still helpful from just a human element of keeping you encouraged. Keep your eye on the ball. Yeah, go look at some open houses. Go take a look at different things. Start to do that homework in the neighborhoods that you're interested in. All of those things, but it comes back to failing to plan is planning to fail, and you have to have that conversation
Oh
with that
man,
lender.
you're too nice. I'm of the opinion at this point that I even tell some of the real estate agents I work with, don't take people who aren't pre-approved shopping.
Sure.
There's a seriousness that comes with it. You're not
Right.
serious if you're not pre-approved because you're not running the numbers. And I've had people argue with me about this. I've had clients fire me over this.
Sure.
It doesn't bother me. It's not worth anybody's time. And I've had to teach, especially newer agents, hey, tell them it's for their own good. I've watched people take buyers on tours, and then we find out the pre-approval was just $10,000 short. So now you've wasted all this time, and you could have been out there really looking at the properties that you could have afforded that have already sold to someone else. So it's not. This is not me, sitting here with ego saying, "Don't waste my time. Don't waste your agent's time. Don't waste everybody's time. Get in so that I need to make these changes to get up to where I want to be, or I need to set my expectations a little bit lower."
Right.
And it's something that we are really happy and thrilled to do. It's one of the most fun things about this industry is getting to help people realize their dreams through practical work like that.
Right.
And like I said, I don't get paid anything up front. I don't charge people for this. We get paid at closing. That's the way our industry works. I'll always be transparent about how I get paid and what I get paid. I don't get paid differently based on what kind of loan you get. Conventional, VA, USDA, I almost said FDA, FHA. They all they pay. It's a percentage of the loan amount. That's how generally almost all loan officers get paid. So
Right.
it behooves us to get bigger transactions, and some of us may find ourselves gearing ourselves away from first-time home buyers towards those who have more money because it's simply more profitable per transaction. And so I think that's where people get a little dissuaded. If you call up a banker and you say, I want to spend 100,000 on a home, it's, you may be a small potato. I'll be transparent about that part of the industry. There are some of us who look at it that way. I'm maybe it's by virtue of being younger, but I plan to be doing this for a long time. So I'm looking at the broader picture. I'm going to be able to work with someone many times throughout my career.
Right.
So this is just the first stepping stone off to that.
Right.
And
Oh,
we
how
can
many
build a
times,
plan for you.
how many times have we had that where,
Yeah.
that house that we helped them buy, became a rental, or we sold it depending on, whatever their life takes them, and we help them do another one. I mean, it's just, it's a stepping stone process.
Yeah. It starts with one, and then you're looking back going, wow, how'd I do that?
Right. Like, eating an elephant, one bite at a time.
Yeah. It seems impossible.
That sort of thing. So,
it seems
anyway.
impossible, but
But
it's one step
possible.
at a time.
Moral of the story is that pre-approval is a big step.
Yep.
We're always going to refer you over to that lender to do it. There's a number of pieces that go into it, and there's a whole bunch of different directions we can go with it. But the bottom line is we need to figure out that you're a legitimate buyer, that you're you have the capacity to buy, that it's a decision that you're good with. And the way you do that is get pre-approved, go through the process, and then run with it. And,
Absolutely.
then we take over at that point and go from there. There's a lot of other steps. We'll explore those in future episodes, but hopefully this dropped a little bit of knowledge on our future millionaire audience.
Yeah, absolutely. And I'm going to thread one last little nugget of information in here. And I'm going to talk about how my industry works. I, as a loan officer, do not deny loans. It's not something I do ever. It's not something I have the capacity of doing. In fact, there's laws against me dissuading people from applying loans. I literally cannot stop someone from applying to me. I can't even say, hey, I've got too many clients right now. Don't apply. I'm legally obligated to take applications. I am your representative in the process. Look at your loan officer almost like a lawyer. Normally you pay a lawyer straight, so this is a little different, obviously, but they're representing you in the case of you getting to get a house. And we want you to. Like I said, we don't get paid until the end. So if a loan officer says to you, hey, you don't qualify for this product yet, it's not them saying, hey, this is my money and I don't want to lend it to you. To be perfectly frank, I'd love to just approve everything that rolled through my office if I could. That's probably why I'm not an underwriter. The underwriter, it's their job to protect both the assets of the bank and to ensure that these loans are, we can get into this in a future episode where we really chew into how the economics of this works. But, when you borrow money to buy a home, your debt gets bundled up and sold on a secondary market. There's a whole thing we can get into mortgage-backed securities, but banks have to be able to rotate their stock, right? It's just like a car dealership. If there's a bunch of cars on the lot and I sell one, I can get another one shipped in by Toyota. Now I get to sell that other car. Same kind of core concept here. There's an amount of money on the table, and when we use it to fund loans, we sell that debt, we get the money back, we get a little piece of that. That's the rotation that happens within the mortgage industry. But again, it's key that you understand that the mortgage loan officer, we are highly motivated to be on your side. We want you to get this. Even if we didn't like you, we have a financial motivation. That's our job. It's the only way we get paid is if we close loans. And so it behooves us. It's in our best interest to find that pathway for you and to ensure that problems don't trip you up. So if I can leave you with something, it's be honest, be upfront, ask these questions, and present the issues that you're afraid of, because your loan officer is your best bet for shaping and painting those problems in such a way that you can get through underwriting. Sometimes the most minor of changes can make a big difference. Deposits are a great example. If Rob's feeling exceptionally generous and he hands me $15,000 in an envelope and I throw that into a bank account and I try to go close a home loan, they're going to go, where did that money come from? And Rob's not direct family of mine, so I'm not allowed to use that. It's cash that it was deposited. There's no paper trail for this money. Really, really tough to use that. But you let it sit and you get two bank statements after that money's been deposited. It doesn't exist anymore. The deposit is no longer a concern of anyone's. I mean, if you throw 15,000 cash in, your bank might ask you a question or two for the IRS, but you know, this is one of the things. I've watched people take mattress money, literally their own cash, and put it into their bank accounts, but too close to the transaction. And then we had to get a gift from grandma for the same amount because we could not source those funds. And literally one of the groups of the government that sniffs through everything I do is Homeland Security. Because believe it or not, we are the largest source of laundered funds in the United States is run through the real estate industry. I would have thought it was laundromats or, you know, I'm picturing Breaking Bad. There's like some sort of car wash that's funneling dirty cash. No, it's real estate. So there are parts of this process that can feel like you're being investigated, and in a fair way you are. You're borrowing an incredibly large amount of money, more money than you've probably ever borrowed. 6 figures, almost certainly for most houses these days. So, you know, be ready for the investigation, but understand that the loan officer is on your side, and it's in their best interest to help you. The more transparent you can be about problems you're concerned about, the more we can address those and make sure that we have an excellent strategy when we move forward, and make sure that they don't bite you.
Yeah, this is just incredible information in the sense that at the end of the day, that mortgage lender is your advocate to get that loan closed. And
it's a win-win.
That loan means you successfully bought that house, and then you're well on your way. So there's a reason why we refer to you. There's a reason why every listener's realtor is going to say, get that pre-approval letter, go through the process, and make damn sure that you have, or that your lender has dotted all of the I's and crossed the T's. And you guys have explored those unknowns, and now everything's known and you're on that path. So I love it.
Worth side mentioning too, if you have a realtor who's pushing you towards a certain lender, it is illegal. If Rob sends me a client, it is illegal for me to compensate him. I cannot compensate him.
Right.
This is by design. So if you have someone that's aggressively pushing a lender, for example, there's probably some purity in that. And that is that they have been burned before. They've dealt with, there's especially some larger national lenders, right, who are a machine version of just, pumping out loans. They're not spending the individual time. They have a real difficulty with anything that fits outside the box. We had a transaction not too long ago where agility was key in getting closed on time. There's a reason that a lot of realtors and lenders end up pairing up, and that's because they like working with people who are very good at what they do. So it can be actually someone who's pushy for one lender. It can be kind of a sign that that person knows what they're doing, I would argue, because they have some skin in the game in making sure you're working with someone who's professional.
There's a word for that, and that I've figured out to describe you as a partner. And what it is it's anticipatory. And what it means is, instead of you having to, sit down and your wait staff, right? Hey, could we get some ketchup and some hot sauce and some water over here for the table? It's already there. You sit down, it's done. It's supposed to happen anyways. Why does that wait staff have to take an extra trip? Just make it happen. Anticipatory. The lending process, the real estate process, there's so many different places that can either become speed bumps or literally holes in the road that you can fall into and never get out of. If you can anticipate them, you can make a transaction happen that otherwise wouldn't. And it only comes through experience and being proactive.
And if you're really good at it, no one will know that you did anything.
Exactly. And hey,
that's the kind of funny irony to it, isn't it? Like sometimes it's the problems that make us look like real pros, but some of the best transactions where you really flexed your knowledge, they would have no idea what they could have fallen into.
Oh, and it's a thing of beauty.
It should look easy if you're really cooking and lucky. Yeah. There's a luck factor. Don't get me wrong. If you have a bad experience, it does not necessarily mean that the people that you're working with failed you. Same thing with a good experience, unfortunately. Which is why it's important to get personal references, I think.
Exactly. I love it.
Awesome.
Well, let's
there's the surface.
And
so go get pre-approved. If you're listening to this and you haven't gone through this process, fill out an application. I don't care if you do it with the worst bank in the world. Just do it to experience the process. There are some things I wouldn't recommend. If you fill out an online form that's for one of these groups that advertises many different mortgage companies, boy, you better get ready for your phone to ring, because you're just going to get blasted by people who buy those. And to me, personally, I don't buy leads. I've worked at places that did. I just, it's just genuine to me. I want the authentic personal connection.
Right.
It doesn't mean that person's necessarily bad, but you just got to be aware they paid for your time at that point. And you may get a better level of service if you have the opportunity to work with someone who a friend or personal references worked for, or that you've had some other way to vet. And we talk about that in another episode.
There's a higher level of accountability there too. So
yeah, absolutely. Yeah. If I'm in a call center in Tennessee, probably doesn't matter that much to me. If your transaction's going sideways, I'm only going to spend a finite amount of time on that. We talk about this sometimes. 10% of the transactions take up about 90% of the time. It's true. When an issue hits, it is much more time consuming than the majority of transactions that go pretty smooth. But when you got people who have to work together on the next transaction too, that's a pretty big motivator to really put in the extra time to work on that Sunday evening to make sure that by Monday morning, all the ducks are in a row, instead of going, they'll probably figure it out tomorrow.
Right. And and what happens is you do 20, 30 or more transactions together every year. You better believe dollars to donuts. I'm
Talk
answering
about anticipating
Adrian's call and vice versa. So that's the huge piece there of accountability versus the call center in Tennessee. What are you going to get?
Yeah. If you're a poor communicator and you're in Tennessee, it doesn't matter. Your company bought another 1,000 leads tomorrow, so you're just going to dial for dollars. Don't worry about it. But when you've got personal relationships to maintain, your clients get to have the weight of our relationship on every one of their transactions.
Exactly. And happy hour on Friday afternoon doesn't happen until the client is taken care of.
So. That victory beer is well earned.
Exactly. There you go. Awesome. Love it.
Love it. Cool.
Thank you much.
Thanks so much for your time, everyone. This is the Get Rich Slow podcast. We look forward to seeing you next week. And if you got any questions for us, please shoot them our way. We love to take feedback. Oh gosh, fuck. Before I leave, Rob, one thing. I do need to make a correction. I'm so sorry. I made a mistake in an earlier broadcast. I misquoted. It's Ferdinand Porsche, not Porsche.
Oh,
apparently it's Porsche. My father is very adamant about that. He's German, from Germany. I was born in Germany. I should know better. So I apologize on behalf of all German people. It's Porsche. It's not pretentious to say that. It's just correct. I'm sorry. That's the way it is.
You stand corrected. I learned a few things today. Oh man, that's awesome. Thank you all.
Yep. Thank you all. We'll catch you next time.
Yep. Bye-bye.